From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. As there's a chill across New York this morning, so a review on the equity market. We drop as the rates market, well, it recalibrates the trajectory for cuts. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, brace for a busy week of Fed speak and economic data. Trump takes Iowa, moving closer to a rematch with Biden. And the bank earnings continue with beats. Goldman Sachs and Morgan Stanley. Let's begin with the big issue. Election risk returning to the street.
This is the year of the election.
An election year.
Election year.
U.S. elections.
The election does present some interesting risks to the economy.
It's a major of uncertainty.
It's likely to be rocky, shall we say.
It's like a spectator sport.
Likely candidates for either a Biden or Trump.
We'll see, how much of an impact the potential Trump Biden race has on things.
At the moment, it doesn't look terribly interesting for markets.
Neither of those candidates, in terms of what they're telling us, are really going to change that longer-term trajectory.
Either the Republicans or the Democrats are going to be very much constrained in terms of fiscal policy.
Focus on how the upcoming election and, importantly, the uncertainty around the election outcome, whatever it may be, could impact the confidence of consumers.
You're going to get a lot of swings.
You will have volatility.
You have an election year in the U.S. that promises to be, bizarre.
Joining me now from Iowa is Bloomberg's Kayleigh Lyons. Kayleigh, trade, tariffs, all of these issues, we'll talk through them in the next hour. But you've had a long, cold night, but it came up for Trump.
It did, and that isn't all too surprising, Manus. He came away here in Iowa with 51% of the vote. Ron DeSantis, who came in second, got 21%, and Nikki Haley, 19% in third. She won one county here in Iowa. Donald Trump won the other 98. He almost had a clean sweep of all 99 counties here in Iowa. Again, we thought he would win. What was surprising, though, was how quickly this race was called for him. Just about 30 minutes after the caucuses began is when the Associated Press and other major networks called this race for Trump. Ron DeSantis' campaign has called that election interference. I'm sure that is a story we haven't heard the end of, but what these networks and the Associated Press said was that it was just clear very early on that no one was going to be able to catch Trump. This really cements his status as the frontrunner in this nomination campaign and his status, frankly, as the presumptive Republican nominee. That said, it isn't over yet. 1 week from today is the New Hampshire primary, and former UN Ambassador Nikki Haley is significantly closer to him in polls in that state. In recent polls, it shows she's in single digits, so we could potentially see an upset there. One factor to consider, though, is Vivek Ramaswamy, who came in fourth here in Iowa last night, has now left the race and endorsed Trump. He was polling in the low single digits in New Hampshire, but the thinking is whatever votes he would have gotten there will just go to the former president. So that could make him more difficult to topple in the first in the nation primary state. If he is able to win New Hampshire, as he did here in Iowa last night, it is very difficult to see how anyone else, Ron DeSantis or Nikki Haley, would have a path to the nomination. If he wins the next contest, it is highly likely that what we see in 2024 in the general election is a rematch between Trump and Biden. Manus.
Katie, thank you very much. Great reporting by yourself and the team over the past 24 hours. Onwards to New Hampshire. Joining me now is Isaac Boltanski, BTIG. So here we go. The headlines roll in. It was called in 30 minutes. Euphoria for the Trump camp. You would say, hold your horses and wait for New Hampshire. Talk me through the reasoning.
Yeah, look, I think that this was an expected outcome. We can look below the surface, and there are some interesting dynamics that I think are meaningful. In particular, these contests tend to catalyze consolidation. And I think what the Trump campaign is loving this morning is that Ron DeSantis won second place, which means that he's going to continue on into New Hampshire. And that means that the opposition to Trump remains fractured. And as long as that opposition remains fractured, as long as we don't see it consolidate around a single candidate, that's good for the Trump campaign. Furthermore, you obviously add that Vivek left the campaign. And look, that's not nothing. He got 7% of the vote in Iowa. So that was a meaningful night for the former president on two different fronts. New Hampshire, to me, is far more meaningful, though, because New Hampshire has been a better predictor of who ultimately gets the nominee. If you look back at the 7 past primaries for the GOP nomination for president, New Hampshire has accurately predicted with their vote 5 of the past 7, whereas Iowa has only predicted 2 of the past 7. And part of that has to do with the caucus dynamics. Part of it has to do with the voter base being more moderate in New Hampshire. But look, I truly think New Hampshire is the big race here. And if Trump wins that, he should really finish up this whole primary by Super Tuesday.
The legal attempts to bump Trump off the ticket, 17 states are still working through whether they will confirm Trump or not, and we have 4 federal cases pending. 2/3 of the voters in the GOP saying he would still be fit for president. These legal issues just don't even stick, do they?
It all comes down to the way that primaries work. And primaries for each party bring out the strongest extremes of those ideological spectrums. And that means that the folks who are going out to caucus in sub-zero weather in Iowa, or who are going to the primary in New Hampshire, they are strongly ideologically aligned with the core of the base. And for that reason, there are surveys suggesting that 1/3 of GOP primary voters are going to vote for Trump no matter what happens on the indictments, or no matter who is running against him. And for that reason, coupled with winner-take-all primaries becoming more and more prevalent, this is Trump's primary race to lose.
Okay, so that's the building consensus. You could have a rematch of Trump-Biden later this year. How far behind and out of the court and misjudging are the Democrats of the current election they're facing?
Look, we're still in a phase here where traditional DC is arguing that there's a pathway where this is a race between anyone other than Trump and Biden. There is still a fair amount of hopium that you hear in political circles here in town. But I think the base case is that it's going to be Trump v. Biden. And Manus, to me, the most important thing here is that you can have as many opinions as you want about how this is going to go, but it's going to come down to about 7 states. And we have to remind ourselves that the last election in 2020 was decided by 44,000 voters in 3 states. You add in the complication with third-party candidates and other dynamic issues such as the economy, and it's easy to see that this is a pick-em.
And that's based on the presumption that it is Biden on the other side of that ticket. Isaac, thank you very much. Let's see how it plays out. That's Isaac Boltanski there on the analysis of the Iowa caucuses. Let's talk about the market implication. We have double lines, Jeff Sherman and Sonal Desai of Franklin Templeton. Here we are, political risk. Neither of you really want to talk about how that plays out in markets so far out. But let me take it to you first of all, Sonal. It's about the risk of tariffs, the risk of fiscal. It's about the risks of maybe what comes if Donald Trump is on the ticket, and then if he wins. Is that how I've got to concern myself from a market perspective?
Can I take a slightly contrarian view here?
Of course.
I'll just note, we all talked about tariffs under Trump. Not one of those tariffs has gone away. And we are over 3 years into the current administration. And I doubt very much that the tariffs will go away under the next administration, regardless of who comes into the White House. So that's number one. I'd just say, there is no difference here. Tariffs seem to be remarkably popular in the US right now. Yeah. It doesn't matter. The other piece is fiscal. Again, if you just look at the mini agreement that the Democrats and the Republicans made, it came out with one overarching feature, 70 billion higher in fiscal spending, lower taxes and higher expenditure in this coming year. Again, neither the Democrats or the Republicans have the stomach for fiscal consolidation. I don't think there's much to choose amongst the two of them.
Maybe they just need to jettison. Maybe the Democrats need a Kennedy back on the ticket, and maybe the Republicans need something else to challenge them. By the way, Bloomberg have run the numbers. 10% tariffs are bad news for 45 states. But you know how much it would knock GDP by? I was shocked by this. Only by 0.3%. It's a vote winner, not a GDP killer. Jeff Sherman, good morning. First take, a runaway train. It's called Donald Trump. There's a long way to go. How do you look at the year ahead? Will politics invect vol for me? Let's just take it from that perspective. Good morning.
Good morning. Yeah, it's quite difficult to see much difference, as Sanal just pointed out, that just go back and look at the deficit expansion that we saw during the Trump administration, see it during the Biden administration, go back to the Obama administration. Do you see a trend here? It really doesn't matter what the letter that the candidate is running with, that we've just seen this massive deficit. And so I think really from the standpoint of the fiscal side, I'm not sure it really matters unless we're going right into the election. Okay. And let's say we hit a hiccup in the economy and effectively Congress will not let something go through. And so I think as we talk about this political landscape, and we're going to be talking about it for the next 10.5 months, I think that there really isn't much difference to markets at this stage. And so looking forward, I think we're going to go back to just looking at the strength of the overall economy. Markets themselves are really focused and very myopically focused on the Federal Reserve today. And I think that's going to be the thing that's going to set the course for markets for the next couple of months, and not really who are these presumed candidates on either side of the equation.
Yeah, it's going to come down to whether it's 3 or maybe even 6 rate cuts and why we're getting the rate cuts. Right. Okay. You're going to stay with me. That's Jeff Sherman and Sanal Desai. They're going to talk through markets in just a moment. Let's get into what's going on under the hood. We've had some reporting before the bell. Katie Greifeld is with me. Katie, what have you got?
Let's start with Tesla, because CEO Elon Musk really leaning on the board here for more control at the EV maker. He said on X that he would want roughly 25% voting control at Tesla to build our AI and robotics products there. If not, he'd look elsewhere. For context, he's Tesla's biggest shareholder with an almost 13% stake. Tesla shares down slightly. Let's move on to Goldman Sachs. Of course, reporting earnings today. It's down slightly despite beating profit estimates at the bank's equities and tradings unit. The revenue jump there was triple analyst expectations. It's worth noting, though, that fixed income trading and investment banking fell short. And let's end with Apple here. 2 stories. Planning to remove blood oxygen features from its latest smartwatches, really to get around a U.S. ban of the devices if an appeal of that decision fails. And you also have Dow Jones reporting that Apple is offering discounts on newer iPhones in China. We know that demand is a big concern there. Apple shares down about 2% pre-market.
Okay, Katie, thank you very much. Wrapping up the stocks under the hood. Coming up on the show, guess what? The rate cut debate, it moved to Davos.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening. We'll get 2 or 3.
It's a busy week for the Fed with the speakers coming up. Waller kicking things off at 11 a.m. That conversation coming up on Bloomberg.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening. We'll get 2 or 3. But there is a chance. I've said the one thing we can probably be sure of is that whatever the consensus is here, and not just here, it's going to be wrong. And if we get a deep recession, and definitely it could happen. How's it going to happen? I don't know, but 25% chance it happens.
Former IMF chief economist there, Ken Roller, weighing in on, guess what, the rate cut bets. And the debate over the FOMC's path is heating up. Investors are watching the data this week, including the Fed's Beige Book, retail sales, and more. Meanwhile, we hear directly from the following Fed officials, including Waller and Bostic, on the U.S. economic outlook. Bloomberg's Mike McKee is with me. Kicking it off, Mike, I was just looking at New York. We've got the Fed Empire Index crumbling.
The Empire Index crumbled, but unfortunately for those who want to see that as a sign, the 6-month numbers out. Conditions 6 months from now, all the numbers went up for that. So the question still remains, with the numbers that we have coming, if CPI didn't change people's minds about 6 rate cuts, what possibly could? Big number of the week comes tomorrow with retail sales. We'll take a look at that and see if people spent during Christmas time. Also, the Beige Book tomorrow will give us an idea of what CEOs and companies are telling members of the Fed. Industrial production, see how things are going, whether Empire actually reflects what's going on. Thursday, we got housing starts and jobless claims, the Philly Fed. And then on Friday, we get Michael Barr and Mary Daly. You saw the other Fed officials scattered throughout the week. Daly gets the last word because when Friday's over, the Fed goes into the blackout. We won't hear from them. And so far, we haven't had to. They've said they're basically going to be on hold, and we haven't seen numbers that have changed anybody's mind in Wall Street about that. Nobody thinks they're going to move on the 31st of January, but a lot of people still, 75%, think they're going to move in March. And December of 2024, the feeling is we're going to see 6 rate cuts still, almost 7 by that time. So what is it going to take? We do have a lot of other data coming up, even before the next Fed meeting. December GDP, PCE inflation next week, along with the fourth quarter economic employment cost index. Those could make a difference, but probably not. Then the payrolls and CPI and PCE inflation come back in many different forms during the interregnum. We have the next FOMC meeting on March 20th. So it looks like status quo for now in both the economy and the Fed forecast from futures. The question is, what would it take to change any of that? Will any of those numbers, Manus, make a difference?
Yeah, the ammunition. Does the Fed have the economic data information, ammunition, to actually pull the trigger in March? Mike, thank you very much. Mike McKee with the very latest analysis of your data slate ahead. Jeff Sherman and Sonal Desai are with me this morning. I love what Rogoff says, which is, you know, it's a pipe dream to think that you're going to get 6. He doesn't really know whether you're going to have a soft landing. I mean, it's very candid and very, very honest. Jeff, let me take it to you first of all. My understanding is that the options market has coalesced around 2 to 3 rate cuts. It's only us in the media that are obsessed with 6. What do you make of where the market is positioned for in terms of rate cuts 2024?
Yeah, I mean, I think right now the market's a little optimistic on the rate cutting cycle at this point. And I think Professor Rogoff is doing it the right way to say, you know, kind of the consensus is more like a 3, as you said, it's inferred from the options market. But it's that tail risk that's really driving those incremental 3. And so I really don't think that a soft landing is one that predicates having 6 cuts. In fact, if it is a somewhat soft landing, maybe it's a bit slower to recognize those cuts because with a soft landing, potentially there is a little bit more of inflation out there. And so, you know, we saw that from the uptick in the inflation data a little bit last week. As you mentioned, it really didn't do much to the overall pricing of markets. But this idea that we have this Goldilocks scenario is just something where I think the market is really trying to price the ability to have that optionality. It's like, it probably won't be 6, maybe it's 3, maybe it's 9, maybe it's 12. And obviously those would be very hard landing scenarios to get to those 9s or 12s. But at the end of the day, I think that what you're seeing is that there is divisiveness out there in the data set. You're seeing a mixed bag in the overall data. You're seeing some form of slowing. Okay. And so the market is prodding the Fed along to do those cuts.
Well, at the moment, we've got 6.47 rate cuts penciled in. So now, I like your style. You've come with swag. You just say, look, it comes down to Powell, this newfound lack of prudence. They've only themselves to blame for this market becoming slightly more delusional about 6 rate cuts.
Yeah, absolutely. I mean, look, the Fed did not need to do this. The market was easing for them already, and then it went off on power thrusters, right? In the sense that it is this remarkable internal cognitive dissonance now inside the markets, because if you look at if you look at risk assets and fixed income, whether it's equities, fixed income, the riskier parts of the spectrum, they are not pricing the type of hard landing that would be required to get that 6, 7 rate cut scenario coming out to play. So essentially, this is almost a sentiment-driven rally off Powell's press conference, and I would expect that the Fed is going to have a rather tough time putting that genie back into the bag again.
Well, they're desperately trying to do. Yeah, they're desperately trying to do that. Let's see what comes from Fed speak before the end of the week. Can I ask you both to set out your risk stall respectively? I had a conversation with UBS this morning, Banu Baveja, and he said very clearly, risk premia increases. Disinflation will continue, but risk premia will increase. In that case, Jeff Sherman, where do you want to be?
Well, you want to be in the middle of the stack in terms of credit quality. As Sanal said, you're not seeing the pricing in the lower tier of credits at this point reflective of those kind of weakening in the economic data set. So it's that upper to middle tier of credit. If you want to take risk, it's probably in the double B area, maybe at the higher part of the single B area. But again, the pricing's been reflective of all these rate cuts in there. So in general, I think being good enough right now in this market with credit is the place to be. Spreads are relatively tight on these levels as we had the everything rally over the last 12 weeks. And so I don't think it's time to be a hero and be delving down in the risk spectrum. If anything, use this as a way to trim some of those exposures and try to migrate up a little bit in that quality. But again, you shouldn't be fearful of the aggregate risk in the overall credit markets right now.
So, Sanal, you want to take a little bit of duration, but is that predicated on the same thing? Risk premium increases, and it's a form of hedge.
It's a form of hedge. And the other thing I would note is selectively, actively selecting pockets of risk. Yes, clearly, in our baseline, where you don't have that massive recession, risk assets which are not fully pricing in six rate cuts.
Sanal, in a very quick last 15 seconds, where would you take the biggest risk? I get the hedge, but where would you take the biggest risk?
Biggest risk is in, exactly as Jeff put it, better quality right now.
Okay. That's the team we've assembled at post-hour. Don't worry, I'm sure you'll be back. We've got New Hampshire to get through and a heck of a lot more. It's my first US election to live through in the States, so I'm excited. Jeff Sherman, Sanal Desai there on the markets. Coming up, your morning calls. And later, Chris Harvey from Wells Fargo unveils his outlook for the earnings season. Have we downgraded our outlook so viscerally that the bar to achievement is really quite low? This is Bloomberg. Time for your morning calls and look at what some of the analysts are recommending. First up, Morgan Stanley upgrades target to overweight, pointing to an attractive valuation and a constructive setup. Next up, Wells Fargo downgrading Boeing to equal weight, expecting limited upside as the FAA takes a closer look at its operations. And finally, Mizuho downgrades PayPal to neutral, sees competition and headwinds forming from Apple Pay and Zelle. That's if you can find a restaurant that takes your Apple Pay at your table. Coming up, the banks are under pressure despite a pair of beats. That conversation up next with Chris Harvey of Wells Fargo on Bloomberg. Down to the market open. Now, we originally had a little bit of a bid in Goldman Sachs. Morgan Stanley was a little bit more tepid, but that bid for the banks has dissipated. Futures are lower, waiting for the opening in the cash market. The rates market is reviewing the trajectory, and as Ken Rogoff said, if you're thinking that you're looking for 6 rate hikes and rate cuts in 2024, that's a pipe dream. Okay, that's state of play on the equity markets for you. We're rolling down ahead of the cash session. I can tell you Morgan Stanley is down 2% into that opening bell. Euro dollar is down. The dollar is the driver. The dollar is the alpha in this narrative. It's at a 1-month high as we go into this slightly more risk-off trajectory. We caught up with Mr. Villeroy this morning. He said the ECB will very probably cut in 2024, but rate cutting is a game of tennis, not soccer. 10-year yields rise and undo some of the momentum that we saw on Friday on the back of the PPI, and oil is flat and utterly ignoring the escalating situation in the Red Sea and Iran against a number of its counterparties. One sector to watch is the financials, as I said to you. Goldman Sachs, Morgan Stanley moving lower despite the better than expected numbers before the open. Katie Greifeld has the dissection on the numbers. This is about cost cuts for one and IB for the other.
I will say you're not seeing it in the shares right now, but Goldman Sachs is starting to get its mojo back. The bank's equity unit generated $2.6 billion in revenue. That is a 26% jump. Analysts had been looking for 8%, so blowing away estimates there. Elsewhere in Goldman land, you saw its asset and wealth division post its highest quarterly revenue in 2 years, helping to offset some disappointment in fixed income trading and investment banking fees. So Goldman down slightly, or a little bit up now, right now, and Morgan Stanley obviously falling right now. The bank's wealth business, it beat expectations. Can't say the same for trading, though. Fixed income trading basically flat from a year prior. And while Goldman's equity traders shined, Morgan Stanley team totaled $2.2 billion in revenue. That is below expectations, Manus.
Yeah, well, those medium bond traders in FICC certainly was a miss at Goldman's. Katie, thank you very much. Let's stay with the banks. Of course, we got more qualitative information on the earnings call. Sonali Basak was on those calls. What did you learn? Sonali, good morning.
Good morning, Maz. We had Morgan Stanley kick off. And of course, it is the first earnings call for CEO Ted Pick. Now, remember, Morgan Stanley was trading among the richest of the big 5 banks, the big 6 banks. And so you are seeing them sell off this morning. They're saying net interest income in this current quarter will come in line with where it was the prior quarter. And of course, as Katie was talking about, there were some questions about this trading performance here, because not only did they miss, Manus, if I told you that Goldman last year brought in more than $1 billion more in equity trading revenue than Morgan Stanley, you wouldn't have believed me just a couple of years ago. So it is showtime for Ted Pick, and there are a lot of questions about the strategy moving forward. Analysts grilling him about the future. When you looked at the presentation as well, same targets, new CEO. The targets, however, did not have that normal plus or minus that they did around those targets. So analysts looking for Ted Pick to push the bar higher while maintaining competitiveness.
Sonali, I believe every single word that comes out of your mouth. Sonali Basak on the banks. You are the Bible on banks. Let's turn our attention back to tech. Tesla slips as Musk says he wants more control before building up the company's AI products. Is that really the reason that they took 2.25% of a chunk out of the stock this morning? What are they worried about, Ed Ludlow? Good morning.
It's not the reason to Elon Musk's mind. The reason to his is that he wants an appropriate amount of voting control within Tesla's board. The stock is down 2.6%, adding to what has already been the worst start to a year for Tesla since it's been a public company. Prior to this morning's open, it shed $90 billion in market cap. So Tesla's board can't negotiate with Musk because there is litigation ongoing, or at least the verdict has been reached in a Delaware compensation case. But the verdict's not been reached in a Delaware compensation case. Musk's argument is that if he has 25% voting rights under a new compensation agreement, and he would be open to a dual class of share structure, which is hard to do after you've already gone public, then there will be more balance in decision making. Anything below 25%, he thinks that it leaves the company at risk to different points contrary to his own, which, you know, could bring in takeover interest and other things. Read the Post. There were many of them.
Yes, there were quite a few. Thank you very much. The stock trades at 212.71 at the moment, down over $6. Let's stick with tech. Apple is planning to remove the blood oxygen tool from the latest smartphone watches. Now, this is to avoid a ban here in the US. Isabel Lee has the details. So this is called a pragmatic response or disaster recovery scenario. Isabel, good morning.
Good morning, Matt. It's pragmatic indeed, but before we get to that, we do have headlines just in. Apple rejected by Supreme Court an Epic App Store suit, and Apple must change the App Store rules that bar developer links. But going back to that pragmatic decision that you said, so the redesign is definitely to work around that import ban. At the heart of the dispute with Masimo, which is a tech firm in Apple, is really the blood oxygen sensor. So in October, the ITC said that Apple has violated Masimo's patents, and in response, Apple had to pause sales in December, which is a busy season. But last week, Apple presented its redesign, and we have the U.S. Customs and Borders Protection, which is in charge of enforcing the bans, approving. So this means that Apple will keep its watches in the markets. There are still many moving parts, but it remains to be seen. For now, shares are down 2%, Manus.
Yeah, and that is a red headline for anybody, as you just said, tuning in. The Supreme Court rejecting Apple's request for an Epic App Store review. Isabel will track this story. Let's turn our attention back to the banks. Chris Harvey of Wells Fargo, which rates the financial sector as neutral. Good to have you with me. So Goldman's are in, you got Morgan Stanley, the wealth unit beats. Goldman's looks as if the worst has passed for Solomon. It wasn't a bad Friday for the banks. Why are you neutral?
We're neutral because the fundamentals, right? We're not in the right part of the cycle. At least I don't think we are. Typically, you want to get involved in the banks and some of the capital market players when you start to see the credit cycle unfold a little bit more aggressively, right? We really haven't seen that credit cycle play out just yet, and there's a lot to come. So while valuation looks good and the fundamentals are okay, there's nothing there that says, wow, we've got to buy them right here, right now. The other thing is a lot of the mid-cap banks have really performed quite well off the low. I think they're up 30, 35% off the low, and now's not a great time to step in.
Now, in terms of just stepping back from this market, as you said, we've got time. You can see how the rest of the year plays out before you step into the financials. But this is what you're saying about risk. You feel that the market is a little bit too complacent, and we expect to step up in vol or market stress. So, again, my very simple question to you is, how much of an injection of risk premia do you expect to see, and where is that going to pop?
Yeah. So, Manus, this is a great question. One of the things I think we're seeing right here, right now, is the situation that's playing out is fundamentals are okay. The macro is fantastic, right? So rates are coming down, credit spreads are tight, everyone thinks the Fed's going to cut early and often, but the micro or the idiosyncratic is just okay. The other thing is we're starting the year, you had a heck of a year last year, right? You're up 20, 25%, depending on where you are in the stock market. And if you're running a company, if you're in the C-suite, you really do want to manage expectations as you report fourth quarter and you start looking to 2024. So you want to bring them down. And so, again, the setup just isn't right. And as people start to moderate things, and as we start to get to the fundamentals and realize the fundamentals aren't great and that handoff from the macro to the micro is not quite there, we can see risk starting to go up.
So the debate is this. We just don't know how hard or soft this landing is going to be. But there are some big consensus trades, and they are around the Mag 7. And the thesis has been that Mag 7 could turn into Lag 7. When it comes to technology, you get idiosyncratic days like today with Apple and Tesla. But as you look at tech, why do you prefer software to hardware?
Right. So Manus, what we want to do is we're a little bit more conservative. We also like certainty, right? If you look at the software space, you get a lot more certainty. You get a more certain earning stream, right? You get fundamentals that are a lot more stable. Furthermore, the technicals look a lot better on the software side than they do on the hardware side. And so we think the technicals and the fundamentals will probably cause the software space to outperform the hardware space, and you're beginning to see that.
I'm looking at the bond market. The bond market, I mean, the gyrations are pretty intense, aren't they? Friday, it was full bull with the PPI down 10 basis points on the short end. Then we resurrect our fundamental fears that the Fed may not deliver. When you look at the bond market, is it a hedge for you? Will 2024 be a year where you touch duration as a hedge? And if so, to what extent?
Right. So Manus, one of the things we're looking at in the bond market, one of the things that really concerns me at this point in time, is you're beginning to see the 2-year melt, right? On Thursday and Friday, the 2-year is down 10, 11, 12 basis points. Like, I can understand that reaction on Friday, but not on Thursday. And you're now over 100 basis points below effective Fed funds. The last time we were in these levels, or you saw this kind of inversion, was September of 07 and late 2000. Those weren't great times, but here's the funny thing. Back then, the underlying fundamentals for the economy and for the market weren't great. You had credit spreads widening at a pretty aggressive clip. Here, credit spreads are actually tightening. So there's a lot of really conflicting signals in the marketplace, and it's a little bit confusing. But if you ask us what we're looking for in the bond market, we're watching that 2-year, because if that keeps coming down, it doesn't matter what the Fed says. The market is telling you that the front end is just way too tight.
Well, I was with the CEO for Moet Hennessy on Sunday at the Javits Center. I mean, that was a sort of a surreal experience in itself. So we talked about champagne, and then we talked about pricing. And he didn't think he was going to be able to eke out any more aggressive price hikes. Okay, high-end luxury booze is not reflective of the whole market. But I'd ask you the same question about pricing. Is that ability to really push through price hikes fading? And what are the consequences on the stock allocation?
Yeah, so a little while ago we were talking about the risks. And one of the other big risks, and I should have mentioned it then, is pricing. right? I think what's going to happen is we're going to see a lot of price discovery. And what I mean by that is a lot of companies are going to discover they don't have the same pricing power today that they had 6 and 12 and 24 months ago. And the reason being is very simple. The supply chain has normalized. Supply and demand has come back into alignment, right? Because of that, it's very, very difficult to have extraordinary pricing power. And so as a result, I think what we're going to see in the start of the year is people realizing, the market realizing that that pricing power, just that strong pricing power no longer exists. And that's going to cause potentially another repricing of risk.
And the implication for the PE multiples then, I mean, is it that I just look at those consumer-heavy stocks, those consumption-orientated stocks? Is that where the dissipation is going to be, or is that just too easy a lean?
You mean as far as pricing, Manus?
Yes, as far as pricing is concerned.
Yeah. Okay. So what we're seeing and what we've been seeing is it started in the staple space. We started to see pricing pricing growth beginning to decay. And then what we also saw is we saw demand destruction. That has brought out just from the staple space to materials, to parts of the industrial space, to more consumer spaces. So it's getting pretty, I can't just say it's one sector, it's getting to be pretty widespread, and it's getting to be a concern. And this is one of the things that we're focused on, not just management of guidance as we go forward, but how strong pricing is as we go forward. And maybe that's one of the reasons why the 2-year is beginning to slide. Maybe the market knows something that we don't with regard to pricing and inflation. And we're looking at some of the data that's coming out of China, the deflationary data, and maybe that has something to do with it. But all still a lot of good questions. We'll find out a lot more during our earnings season.
How important is China? I mean, some of the hot headlines this morning out of Davos, where you have a reaffirmation of growth in China at around above the 5% level. Yeah. To what extent does China and its growth trajectory this year, the special bonds that they're issuing this morning, to what extent does that play into the equity narrative for you, or do we live a little bit more detached from the China story than we have done in decades gone by?
I think we're a little bit more detached. Everyone's waiting for China to get out of this economic malaise that it's in. It just hasn't been able to happen. I think what's a lot more important at this point in time is the housing market. Right? We're seeing rates come down. We're seeing a lot of home builders rallying pretty aggressively. If you look at the multiplier of housing on the economy and on the labor market, it's quite strong. And so that's where we're placing our focus, not so much on China, but really on housing and what that can do to inflation and the economy.
Chris, thank you so much for being with me this morning. That's Chris Harvey, Wells Fargo. Coming up on the show, rising optimism for U.S. equities.
About the markets, we're looking at a market, equities, U.S. equities, that are breaking out to new all-time highs, double-digit growth for the next 2 years. That's pretty constructive.
For a conversation with Mike Wirth, the Chevron chairman and CEO, right here on Bloomberg. Let's turn our attention back to the World Economic Forum in Davos. Jonathan Ferro and Lisa Abramovich are sitting down with the Chevron CEO, Mike Wirth. Good morning, good afternoon, John, Lisa.
I've been told I've got to pick one, Manus, so I think we're going with good morning. We're going with good morning.
No, we went with good afternoon.
We're going with good afternoon.
Yeah, but it's okay. We're going on to equal opportunity.
So now I'm just even more confused. Good afternoon, Manus Cranny. Thank you, and good morning to Chevron CEO Mike Wirth. Mike, how are you?
Good. Good morning, John.
It's good to see you. Fantastic to catch up with you. I think we have to start in the Red Sea. That's where the urgency is right now. Clearly, a lot of businesses have to reroute business. We saw that from AP Moller-Maersk, the container shipping giant, a number of weeks ago. Some breaking news in the last couple of hours on Shell. Could you give us the update for you and the team? What have you had to change, if anything at all?
Sure. We engage with the U.S. Navy and other security organizations for all of our movements to the Arabian Gulf, the Red Sea, and on every voyage we have a security plan, and it's really ship by ship that we evaluate the situation. So we're working very closely with the maritime security authorities. The risks in the region have been accelerating over the last several weeks. These are risks we deal with all the time. Last year we had a couple of ships attacked by the Iranian Navy. Actually, one of them was boarded and hijacked into an Iranian port. So this is a part of our business that we deal with. We take it very seriously. The safety of our people is the most important thing, and the risks in that part of the world are very dynamic and volatile right now.
Have you made any changes in the last few weeks?
We've made changes that we don't talk about publicly in terms of the security protocols. We have not made fundamental changes to how we've been moving ships over the last few weeks.
Are you surprised that we haven't seen any influence on prices whatsoever?
I actually am. That's an important part of the world for oil supply, and traditionally, when risks elevate in the Middle East, you see it reflected in markets. We've not really seen that yet. And so I'm a little surprised.
So what do you think it would take? I mean, do you think that the excuse that people use, which is that the U.S. is just overwhelming the world with oil, and that's the reason why oil prices have remained completely immune to any tensions in the Middle East, do you buy that story?
Well, certainly U.S. supply growth has surprised people to the upside, and I think it has helped calm markets a little bit. But it certainly has no ability to cover up a big disruption in the Middle East. That will fundamentally change the supply dynamics in the world if you were to see shipping halted, disrupted, or seriously disturbed. And so I do think that the U.S. supply has helped kind of calm markets over the longer cycle, but there's no capacity to respond in the short term to an interruption like that.
13 million barrels a day. Can we just sort of frame this just for a moment? How much potential is left? How much higher can that number go?
It can go higher. The U.S. is blessed with an abundant resource base. The constraints tend to be, right now, the capital spending of suppliers, how fast suppliers will go. A decade ago, companies in our industry were growing too fast in the Permian Basin in particular, and investors were unhappy with that. I think we've seen companies throttle back capital spending, return cash to shareholders more consistently. If they were to return to the ways of the past, I think you could see that number go higher. I don't see that going on right now, but the U.S. has upside.
Well, but this is the reason why people are wondering about the potential disruption. And I'd love it if you could quantify where we could see prices go if some of the disruptions that you're talking about come to pass, if the U.S. still has the ability to produce more oil, right? If there is the ability to ratchet it back up, couldn't that offset the disruption that potentially could happen that we haven't seen yet?
It could, Lisa, but not immediately. So between the time we actually have all of our plans ready to drill a well in the Permian Basin and when it comes on production, fastest is like 9 months. And our plans are set for years in advance. I mean, we've got it's a big system that you run to do this. And so there's not a light switch that says, okay, we had a disruption in the Middle East today. Next week, we can have more production in the Permian Basin. There's a lead time involved here. So you could see short-term dislocations in the market.
How much?
It's a very hypothetical question.
Give us a price.
Come on.
You know, when we saw the Russia-Ukraine conflict begin, you saw prices well above $100. That's conceivable. If you were to see a significant disruption, Red Sea may be less than the Arabian Gulf because there's alternatives for shipping through the Red Sea. The supply that comes out from Saudi Arabia, Kuwait, Gulf producers that comes through the Strait of Hormuz, if that were to be closed down, that's a significant supply shortfall, which could really impact markets.
You delivered a big deal at the end of last year, I think 50 billion plus. Do you think the demise of fossil fuels is greatly over-exaggerated?
I think people have an unrealistic expectation for how quickly the energy system can change. The energy system is enormous. If you look at the overall mix of supply, 20 years ago, 84% of the global energy system was fossil fuels. Today, it's 81 or 82%. Despite all the advances we've seen in wind and solar and renewables and electric vehicles, the demand is much higher and the mix hasn't changed much. And so fossil fuels will be used for many years to come. Oil and gas will be used for decades to come. So I do think that there's been an underappreciation of the longevity that this business has.
A delicate question, slightly provocative. Does California have maybe a little bit too much confidence, hope that things can change that quickly?
Well, California's been on a path for a couple of decades to tighten up regulations, rules related to our industry to try to encourage other forms of energy. And we've certainly seen We've got a large position. We made the first discovery in California back in 1879. We're really the only large oil company left in California. We've seen the investment climate change dramatically, and we've got a very large business there, but we won't be investing as much in the future because those investments just are less and less attractive because of the policy environment. And I do think that ultimately is to the risk of California and California consumers.
Has any politician reached out to you after you made your announcement to say, just kidding, come on back, we'll make things change, we'll make things easier for you? Did anyone reach out?
No, we have means through which we work on policy with the state of California, but these are decisions that have been long thought out. In fact, in many ways, we're justified on the belief that a new energy system would emerge and that California should wind down the current energy system that it has today. And so the policy is very consistent, I think, with the intent of the policymakers, and so we're just seeing that play out.
I'm going to get shouted at, but I think we've got about 40 seconds. Does it matter who's in the White House, given that we have a Democrat who wants to get rid of fossil fuels, but we also have 13 million barrels a day of production in America? Does it matter who's in the White House?
Well, because of some of the lead times I was mentioning earlier, what happens are decisions to make permitting more difficult, to cancel lease sales, to cancel pipelines. Those have impact down the road. What we see going on in the market today is a result of plans and permits that have been issued in years prior. And so there's a lag time in some of these things. And so some of the policies that you see come into play, the manifestation of them, I mentioned California, 20 years of policy making that's playing out today. Same thing applies at a federal level.
Mike, this was great. It's good to see you. It's great to catch up.
Good to
Mike
see you,
Worth there of Chevron. Manus Cranny, we'll throw it back to you. Good
Jonathan
afternoon.
and Lisa, thank you very much. Great conversation there. An interesting nuance between what goes through the Red Sea and the Strait of Hormuz. That is when the real crunch point will come from Saudi and Kuwait and those other nations traveling through there with their oil and their product. Countdown to the Open finishes. We're in Davos at Davos House. Follow the blog. Follow everything on Bloomberg Terminal. Pick it up on Bloomberg.com. And, of course, Bloomberg TV. I'll be with you tomorrow morning and we'll be back to Davos. This is Bloomberg.